Is gold being sold off unfairly? Yes, gold should not be down with stocks. But when you look at the fact that there is hot money in gold, there are people who are selling gold now, not because they're bearish, because they're long, and they probably figure they're going to get a chance to buy it cheaper later on. China's real gold buying is far larger than the official numbers, according to that new work highlighted by the Financial Times and reinforced by our own multi-year analysis. The PBOC reports small monthly additions, yet evidence from SocGen, Goldman, and London bar flows suggests China may be acquiring hundreds of tons through hidden channels tied to its de-dollarizing strategy. Analysts quoted by the FT, SocGen mostly, say China's true holdings could already be near 5,000 tons. It's more than that.
Gold's record rally is not just investor-driven. China's hidden accumulation strategy is fueling it. Vince Lanci notes that gold is now trading in a wide $4,000 range and currently sits at the top of that range. He openly admits that he was bullish and remains long, even though he is currently losing money. But he says he'll grin and bear it, because the bigger story behind gold's strength is not short-term price action, it's structural demand, much of it coming from China. According to Lanci, the Financial Times now confirms what he has argued for years. China is quietly buying far more gold than it reports, as part of a long-term plan to reduce dependence on the US dollar. Research from Société Générale, Goldman Sachs, and London Vault Flows indicates China's real holdings may already exceed 5,000 tons, far above official numbers. Only one-third of central bank gold purchases are publicly reported, meaning most buying is hidden. This opaque demand explains why gold keeps making new highs despite market volatility. Lanci also links this to China's broader strategy of countering US dominance, whether in AI or in currency. Just as China challenges American AI spending claims with cheaper alternatives, it is quietly shifting global monetary power by accumulating gold off the books. As James Rickards has explained, even the Chinese military can buy gold without reporting it, ensuring independence in a crisis. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors. Don't forget to tap the bell icon for more daily insights into the financial system. Thanks for watching.
Now, let's be honest about gold for a second. The last $200, as much as I loved it, were contingent on the Fed cutting 50 basis points. I mean, we're trading $4,000. We're in a big range. We're at the top of the range. Of course I was bullish. Of course I'm long. Of course I'm losing money. But, I'm going to grin and bear it. But staying with the facts, so you have this double whammy out there that's been kind of looming. AI is overvalued. AI is overvalued. AI has got a credit problem. Plus, yesterday, the new thing was, oh shit, the Fed may not cut. And so the combination washed everything out. Is gold being sold off unfairly? Yes, gold should not be down with stocks. But when you look at the fact that there is hot money in gold, there are people who are selling gold now, not because they're bearish, because they're long, and they probably figure they're going to get a chance to buy it cheaper later on. I have to think even macro discretionary took a hit today. And what I mean is they're long stocks, and the stocks are getting slammed, gold's getting slammed, et cetera, et cetera. So when you look at it from that lens, and I'm going to add one more thing. Over the last year, China has been slowly encroaching propaganda-wise on the U.S. American exceptionalism of AI. If you look at Trump as a propaganda artist saying, we're going to have the best AI, we're going to spend the most money, and China's coming back saying we did for $5 million. And China's making more announcements to that effect. We're doing it cheaper. What you're doing is you're making our valuations look too high on the optimism. You show that we are in a bubble. I believe, frankly, I accuse China of doing what we do, and that is counter propagandizing the markets. They're exporting their propaganda now to us. Am I blaming them? No. That's the way the game is played. The FT asserts China's hidden gold buying drove the record rally. As noted in this space, and detailed using proprietary methods, breaking down reports from Goldman Sachs, SocGen, Jefferies, and our own observations, paraphrasing James Rickards several times in this space. Over the last 3 years, China's central bank and related entities appear to be buying far more gold than they officially report, creating a large and opaque source of demand that is closely tied to a broader effort to reduce exposure to the US dollar, and that helps explain the current record bullion prices. Now, it's not news to you. Let me shrink this a little bit. That's my notes on the side there. That's not news to you. It is news to most of the world that we live in. That's going to raise awareness. Does it matter? Does what's happening today matter? No. Is China not buying today? Of course they're buying. But here we go. China's real gold buying is far larger than the official numbers, according to that new work highlighted by the Financial Times and reinforced by our own multi-year analysis. The PBOC reports small monthly additions, yet evidence from SocGen, Goldman, and London bar flows suggests China may be acquiring hundreds of tons through hidden channels tied to its de-dollarizing strategy. Analysts quoted by the FT, SocGen mostly, say China's true holdings could already be near 5,000 tons. It's more than that. Only 1/3 of global central bank buying is now reported, creating a powerful, opaque source of demand that helps explain gold's record highs. We also noted that only 1/3 of gold central bank buying is being reported now. So 2/3 is not. And it probably has been that way for years. We would remind people China's army wealth is not on their balance sheet. It's separate from the government. The army and the government are separate. That happens in a lot of countries that aren't liberal democracies. The army is separate from the government. And so when, as James Rickards used to say, when the army wants to buy gold, that doesn't get reported. They need to make sure they're self-sufficient in the case of revolution, and that happens in China and other places. The first time this actually was disclosed with some sort of evidence was probably Zero Hedge, a little over 2 years ago, maybe, and Bloomberg right around the same time. But it was Goldman that actually started to show us in their new methodology. It wasn't new, they had it all along, sharing with us how it's done. So that's the story. That was sent out today. It's a very good piece. It doesn't say anything hardcore gold fix people don't know already, but it does frame things in a way that the rest of the world will understand. Of course, it makes China look like an evil player, and of course, it demonizes gold.
Gold, Bitcoin, and the markets are all under pressure. Yet hidden demand and Western financial strategies are quietly shaping the next wave of money. Vince Lanci explains that markets have been balancing stimulus expectations against potential rate cuts, affecting both gold and equities. Recent talks of $2,000 stimulus checks and a possible 50 basis point Fed cut have provided temporary support. Despite this, Lanci warns that the markets remain under pressure from deeper structural risks. Rising concerns about AI overvaluation and credit stress are creating recessionary signals, and tech stocks are beginning to show signs of weakness. Bitcoin has also been moving in line with tech, while gold and silver experience temporary rallies, reflecting both physical shortages and financial flows. Adding to the story of scarce assets, Lanci notes that Citibank has warned there isn't enough physical gold to meet upcoming demand. He agrees with this assessment and plans to break it down in more detail for premium subscribers. He also touches on Catherine Austin Fitt's recent insights on stablecoins, emphasizing their role in the evolving Western financial system. Finally, Lanci shares a special perspective. He believes Bitcoin will eventually become a G7 central bank reserve asset, as Western systems seek to maintain dominance alongside gold and stablecoins, bridging traditional and digital monetary frameworks. Let's get back to the video.
Citibank notes there is not enough physical gold for the coming demand, period. That's their way of looking at things, and it makes sense. We've looked at that, and we're going to break it down for premium over the weekend. Next, Catherine Austin Fitts on stablecoins. We said we're going to put that out, but we've been a little bit busy. And finally, special, as much as some of us may hate to admit it, Bitcoin will be a G7 central bank reserve asset. That's our opinion, and it's because we need to stay Western, and stablecoins and gold are Western. We've been saying we're going to put that out for a couple of days. We've had it written up. We've mentioned it to Marty on his show, and we actually mentioned it yesterday on Bitcoin News. But this story came out yesterday. Czech central bank buys $1 million in Bitcoin, other crypto assets for testing. Now, if you sit there and you say, oh, they're just buying it for testing. No, that's not what they're doing. See, 2 years ago, they said in a Reuters story, this is Reuters, by the way, in a Reuters story, they said, we're skeptical about Bitcoin. In January of this year, they said, another Reuters story, we're looking into Bitcoin. And now they're buying it. They've already made up their minds. Okay, now is the Czech central bank the G7? No. Are they a major economy? No. But Eastern Europe, that former uh, Warsaw Pact nation group, they sit in between the East and the West. And while they may be ideologically Western, freedom, democracy, they're economically Eastern. Who's been buying gold for the last 10 years? Poland. Who's been buying gold after Poland for the last 10 years? The rest of the world in Europe. And Western Europe is buying too. Understand that when 30% of central bank's assets are gold, which they're going to be, Western G7 banks are going to hold, they only hold like 20 now. They're going to hold 30% of their assets in gold. Why do I know that? Because Poland's going to do that now, and they're all going to follow Poland. Now, when you have 30% of your assets in gold, that's a lot. It's necessary, but it's a lot. You need something to mitigate that. Is it fiat? No, you need to sell more fiat and buy another substitute, stable coin, some stable US Treasury, and throw a little Bitcoin in there. That's what we're going to do. That's my opinion. So gold's at 118 now. For the last week or so, the markets have been weighing stimulus versus rate cuts. I'm referring to gold. And I'm referring to stocks as well. So on the plus side, you'll notice over the last 48 hours or so, Trump has been talking about $2,000 stimulus checks, and Bessent essentially confirmed that yesterday, or the day before, I should say. Now, that's the positive force behind these markets, plus the expectations that the Fed would cut as much as 50 basis points in December. Now, the counter coming into yesterday was that AI valuations are too high, and that was weighing on the market. The AI valuations too high are a function of two things. The main thing is the Western markets are waking up to things that Zero Hedge has been saying for a while, and banks are now picking up on, and that is that the CapEx incentive and the build baby build, which is really what it is, has incentivized stupid money to borrow to build things. So my taco stand is now an AI taco stand that gives me the write-off. I take out some debt. So when you look at that increased sloppy borrowing, bubble borrowing, combined with the fact that AI really isn't profitable yet, it only and we assert and we'll reassert again, AI will not be top line profitable. It will not create new demand for things that people didn't want before. It will, however, create bottom line profits. And that's when people get fired, and people are getting fired now. So on the negative column, AI is overvalued. People are starting to be aware of that. The credit problem is cracking, and people are getting fired. That's recessionary. What's holding the market up? The stimulus, but more importantly, the Fed saying they're going to essentially cut 50 basis points. That had been a struggle with stocks holding their own, but tech stocks starting to get hit. And Bitcoin moving with tech stocks. And gold rallying and then backing off. And silver rallying more because of its own physical shortcomings. There's not enough out there. And then selling off on financial selling. They're selling what's not being tied down.
The markets are navigating a highly complex and interconnected landscape where expectations of government stimulus, potential Federal Reserve rate cuts, and structural risks stemming from AI overvaluation and mounting credit stress all intersect. At the same time, scarcity in physical gold, growing adoption of stablecoins, and the gradual integration of Bitcoin into central bank reserves are signaling a profound shift in the global financial system. Investors are now confronting both short-term volatility and long-term structural changes as traditional and digital assets increasingly intertwine. This evolving dynamic underscores a transformation in how value, monetary policy, and financial power will be managed and distributed in the years ahead, creating both opportunities and challenges for market participants worldwide. How is China's hidden accumulation of gold affecting global prices and central bank strategies? So stay tuned and don't forget to like and subscribe for more daily insights. Thank you for your support, and I hope you enjoy the video.